Hello, Jim here. One great way to make some extra income every month is by selling options. I typically have done it with what I call value companies, companies that pay dividends and grow dividends. But today I want to change my emphasis. I've recently found a couple of really good growth companies that I like that are also related to AI, or one of them is at least. I'm going to talk about how I found them, why I like them, and share with you the trades I made on them. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's jump right in. Don't have much economic wise to add this week. The PCE number came out, and again, it was a bit higher than what the Fed typically likes. It's pointing to like 4% yearly inflation, and I think they want 2%. I think 2% is too low, but I do think it's going to push the point that they're not going to increase or cut rates anytime soon. I'm still thinking maybe third quarter, fourth quarter if we're lucky. It may not be till next year. And then the other thing I have noticed with the market out there, it seems to be a lot of greed, a lot of people trying to make a lot of money. And whenever I start seeing that, I begin to feel that or believe that the market may be hitting a plateau and maybe start turning the other way. So I think we're due for some kind of a correction. I could be completely wrong, but as always, please be careful with your trades. Don't take too much risk, and realize that can always happen. I think on a yearly basis, we do get one correction each year. I think possibly close to 10% on a yearly basis. So I wouldn't be surprised. It's kind of a healthy thing for the market if it gave back a little bit of the gains. So with that being said, let's jump right in. At the end of the video, I'm going to actually share these two companies that I did the trades, and I'm going to share details about them, how I found them, why I chose them. And in the trades that I made, they were probably some of my most profitable trades I've made in a long time. Now, one reason that I chose them is they've had lots of earnings surprises. They've had good reviews, good year-over-year earnings. One has really good profitability, the other one not so much. And I think that's key. If you see some good growth on a yearly basis and you have a lot of upwards revisions, that's a really good thing for a company. And then for profitability, I look at return on investment, return on invested capital. One of them has really good return on invest ROE and or ROIC. The other one not quite as much, and we'll look at that in detail at the very end of the video. I typically like to see at least equal to what the sector that they're in or the part of the market they're in, that they have a similar, if not better, ROE and ROIC compared to those other companies in that sector. And that's one thing that I think I've overlooked in the past. Now I'm beginning to really look at it. I've done some studies and listened to some other videos and read some papers where it really says if you look at the profitability, it can really be the game changer. And again, with trading options, what is so key is picking the right company. And it's not just for options, it's just investing in general. Pick the right company and you've won half the game. The other thing I typically like to look at that I've been talking about for a while, but at first I didn't do enough of this, looking at their debt. How much debt do they have? Both of these companies have debt well under control. I believe one or both have one has little debt and the other one has no debt. So that's something also to keep in mind. And then if they do have debt, is it way above what they should have compared again to what the industry average is? And then also, is it currently at a fair price? Some of the stocks out there I really like, but they're really too pricey. If there's a correction, they're priced for perfection. A correction would cause them to come down a considerable amount. An example is NVIDIA. Even though NVIDIA still PE isn't crazy, it still has a really high price. And it's not alone. There's a few others that, have 60, 70, 80 PEs or price to earnings ratios, which I think is way too high at times. Again, if you can compare that to what the industry's norm is, and if it's within a certain amount, plus if they have a situation like really high growth, well, maybe they do or should have a higher PE, but some of these are just through the roof. Also, income per employee. How much are they making on an employee basis? Can they do more with fewer people? I think that's also key. And then also cash per share. That's another figuration or configuration or profitability factor that you can look at to also determine how good a company is. And then probably just as important to me, at least with selling options, do they have plenty of expirations? Do they have plenty of strikes? A fair amount of volume? Because I typically do like to sell options on them. Once I own them, I like to sell covered calls for many, many years. And if I prefer them to have that, there are some instances where I do own companies that don't have very good options volume. And in those instances, I don't make as much, especially with the covered calls. And you'll see that when we talk about some of the trades at the end of this video. Now, I'm going to jump into the next part of the video, but before I do, I just wanted to mention, as always, please, subscribe, hit that like button. If you're curious about my memberships, I have two memberships. One of them is a coaching related membership, and the other one is kind of a basic membership where you get my trades, you get my worksheets, you can interact with me. The more expensive coaching membership on a weekly basis, I can provide coaching, some hand holding, help you if you've never traded options before, as well as you get access to Discord. And then every other week we're having group meetings. We meet Sunday evenings and we talk about certain things. This coming up Sunday, we're going to be talking about the poor man's covered call and how you can use it to make some really good trades. So that being said, let's jump into the next part of the video. Okay, now to start out, I'm going to share with you within Schwab what these two companies look like when you bring them up under the research tab within Schwab. The first one is Path or UIPath. This is an AI-based company. It's one that Kathy Woods has talked about for a long time. It's been on my watch list for several years. I typically will not trade in any company that doesn't have profits, and now it has profits. So I've made my first trade with it, and it's worked out fairly well. But let's take a quick look at it. So currently, if we look at it over the last 3 years, actually, that's not a good emphasis, but you can see it's not quite at the high level of its 52-week range, but it is probably closer to the high. I think the high is 27.87, and it's currently 23.65 up today. Its low was back 14.15 or 12.38. And I do believe that you can't go too far back. I mean, actually, if you go pretty far back, you can see when it made no money, it was a much higher price, which to me is crazy. I can't invest in something that's not profitable, so that's why I'm sticking to a year with it. So the trade I did is right around 20, so it's over the last 4 or 5 months, it's a little bit lower than where it currently is, and it went up quite a bit with last earnings. I believe, earnings were right here, and you can see what happened last time. So it went up significantly. And here you can see the different news about UiPath. Here's their expected earnings. And you can see they significantly beaten the earnings pretty much every quarter. They still do have a pretty high PE ratio of 49. Which I think will come down, if they do 50 cents on average, and that's showing the 49, that's with maybe potentially doing 50 cents for next year. If they actually do closer to $1, then they're really not overpriced. And again, with their rapid growth and being an AI company, they are warranted the higher PE. It's still a little bit higher than I prefer. And with doing the put that I did, I believe I did a vertical put credit spread. I did it around 20, which would probably put it more like a 35 PE. And you can see here, it does have pretty good earnings per share growth and net profit margin. This is the company that I talked about that profitability isn't quite as good as I was hoping it would be. I believe it's because they've issued a lot of shares. Now, if they keep increasing the profitability or increasing the profits so much, profitability will catch up, is what my guess is. They do not have any debt, which I think is a huge bonus. Again, though, they are issuing a lot of shareholder equity. You can see it's increased from only 500 all the way up to 2736. So that is a little bit of a concern. Now, if you come over here, this is Seeking Alpha. If you're curious about Seeking Alpha, I am an affiliate. There's details in the description if you want to sign up for them. If you do it through my affiliate link, which I will get a little bit of a kickback from them, but it's no more for you. I believe they do have a discount. I think can't remember what it is exactly. It may be like $80 off or something. It's on a yearly basis. But I've been subscribed to it for 2 or 3 years. I was subscribed to it well before I ever became an affiliate. I like them. I like the ratings and how they do it. Again, they have a graph here, and I won't go into detail, but they have nice stories or analysis. And what I like to do is go in and look at the comments and read what the different analyses are. And it also talks about Kathy Woods and the fact that ARC has had Path in there for a long time. But I don't necessarily, sometimes I don't know if the people who are doing the analysis are, sometimes I question their motives. So that's why I find the comments are really good, looking at what other people are commenting. And they're not always the same. Some of the analysis is better than others. Now, I like to, go in and see the details about the ratings, valuation, and, it may be a bit overpriced is probably where it's coming from with the D plus number for that. But you can see A plus for growth, B plus for profitability, A for momentum and revisions. They don't pay dividends. So here with earnings, you can even get a better visual picture. So they've probably are getting better with estimating, but they typically have blown away. Their profits have been much higher. They've beaten by a fair amount. Of course, we're talking just literally cents here. So instead of 5 cents, they do 10 cents or something along those lines. But they're looking to increase next year by a fair amount. Now, valuation, again, is a concern. They may be a little bit pricey, but again, with beating earnings down the road, that may change. Suddenly, it may not be overvalued. Growth, they have good growth, both profit-wise and then also revenue-wise. And then profitability is a B plus. What I typically like to look at is I like to look at return on assets, and they're negative. And my belief, or what I've looked at, is, again, with issuing a lot of shares, being a startup, and they've only started to make money recently, I believe over the last year. I think this number will be turned positive at some point. And then return on equity, again, a negative number here, which I don't really want to see. So if you look at making this kind of a trade on Path, this is something you should look at. And again, momentum also looks good. So, a good company. There is some risk. So again, always do your own due diligence before you, look at making a trade like this. Now, the other company that I like, and I actually found this through Seeking Alpha. It was, and I'll show you that when I go back. It was in their list of one of their favorite companies. So Surge Pays, it's a telecommunications company. This is a very small company, so it's a little bit unusual. It's a very fast-growing company, but definitely a lot smaller than what I typically deal with. And here, it looks like it's all over the place, but just remember it's currently $7.80. I think I did the trade at $7.50. It turned out to be a pretty good trade. I think with the premium I brought in, it would be more, if it gets assigned to B, it would be more like $6.50. And again, their numbers are changing pretty quickly. You'll notice they also beat earnings, and they've just only recently started making money. But they're definitely on a tear. And then if we come down, we look at their debt. Their debt hasn't been crazy. It's been around, and I believe that's millions of dollars, not billions. They're 100, I think they're 120, 130 million dollar company. So they're definitely smaller than what I usually deal with. You know, so not crazy with debt, but a little bit of debt, but nothing crazy. Now, if we come over here and we look at surge here too, and let's come to the main summary place, but you can see for analysis analysts, it's a buy and strong buy by both Wall Street and Quant. And Quant has a lot to do with revisions. So they've revised their earnings up numerous times, which is very unusual. So that's why they have such a strong rating. PE, their PE is only 457 because they're bringing in $1.60 earnings per share, which is a little bit crazy for a small company. Again, some good analysis and with lots of comments. So another good place to see what people are saying and see who likes them and doesn't like them and why. If we look at earnings here, you can see again, you can see year over year is increasing, and the fact that they've beaten by such significant amounts, I think that might continue. At least that's what I've seen with some other companies. I've also noticed this with Zoom, that they seem to, their analysis or their expectations, usually they end up beating them. So they under promise and over deliver, which I think is good. It's what I do with my development and programming work. And it's a good way to kind of run a business. So their earnings look good, no dividends currently. Growth, A plus, one of the fastest growing companies I've seen. Profitability, I do like. They have some good profitability. So you remember we just looked at return on common equity, but look at this. For them, it's 169. Return on total capital, 61. And then return on total assets, so they blew it away. And this is the sector margin, so this compares it to the sector, and they're doing quite well. Again, this is a very small company, so these numbers look like wow, wow, wow. But it's not necessarily something you want to invest in. As always, like I said earlier, be sure to do your own due diligence before you try to make a trade in this. Now, what I did like is the momentum is really, really good. And then they have quite a bit of options activity. So you can see here the numbers are pretty good. So again, both these companies, different in nature. Part of the reason why I like Path AI or AI Path is also with being a programmer, I've been looking at their tool set and been fairly impressed. I'm getting ready to download it and really, give it a try. If it can do some of what they're saying, which it seems like it can, it could even be a time saver for me. So now let's jump in and we'll look at the actual trade. So I'm not going to worry about the others. This is my monthly planning worksheet. I release these every week to my membership, and I used to have one huge spreadsheet, but I decided to do a weekly spreadsheet. And you can see here for February, and today's last day of February, and my monthly goal is 6,400. So I'm at 6,515 after all the trades I've made this week. And I don't do a whole lot of trades. I do one, possibly two trades a day, 4 or 5, maybe 7 trades a week, and try to keep it very, what I call passive. It's not really what you would truly think of passive, but it's a very small time commitment. I'm still developing, I'm still consulting. I'm actually helping my son start his own business, so I'm very busy. So I don't want to have to spend a ton of time with this. And down the road, once he's running his own business, and luckily my current product that I'm working on with one of my clients for my development stuff is nearly done. So it's only bug fixes and some improvements and some additional functionality that we add for it. But I'm not going to go through each of these trades because it'll take too long. I'm going to go through these last two, one being Path. One is in my, actually these 11 and 12, which is Surge and Path. They're both in my Fidelity IRA. Now, I used to call this my new Fidelity IRA, but one of the things I've been doing is I'm having all my retirement accounts in Fidelity, and I'm going to have my taxable accounts at Schwab. And I've been in that process all February. It finally finished today. Everything has been moved over to Fidelity. So, that's why it's Fidelity IRA. I currently only two accounts I have at Schwab, or two primary accounts. Everything else is at Fidelity. I trade in both. I trade in both my IRAs, my Roth, and my taxable accounts. I do probably more trading in my IRA, this IRA that I'm talking about here, than anything else. So I sold a cash secured put first with Surge at 750. It expiring in May, so a little farther out. The current price was 720, so it was actually in the money when I did it. And I decided to go ahead and do that. It brought in good premium, so I think, and we'll look over here. Yeah, it brought in two contracts with this, and it brought in over $258 in premium. So, when you look at this 750, I believe is what I did. And it only had, I think it had $5 and 750. So I only had those two to choose from. And I'm okay with owning this too, but being 750 times two, that's 1,500 minus the 258 is the required capital of 1241.36, which is also my max loss. But then the yearly return is 94%, one of my highest. And, that's pretty much this divided by this and then adjusted for the year. It would be like a 94% return for the whole year. So it worked out really well. My big question is maybe I should have done more than two. And I may do more depending on how this works out. But so far, it's only been 2 days, but so far so good. Now, Path, I literally did yesterday, and I did it as a vertical put credit spread, and I found really good premium with thinner spread. So I typically do a $10 spread. I did a $5 spread, 21 and 16. I didn't go out as far. I did 419.24. At the current time, it was 23.74. And I think this was like a 30 delta for the put. And then I was showing earnings as 313. I did have some people question, why would I do a trade with earnings coming up? But I don't necessarily worry so much about earnings. I just like this trade. I do want to own them. And I have a sneaky suspicion that after the earnings in March 13th, it may shoot up into the high 20s. I wouldn't be surprised. So I probably won't be able to pick it up. But if it dives, has bad earnings, then I'm perfectly fine with picking up. Now, I did 4 contracts. I forgot to show that. It is 4 contracts. So even though I have a thinner spread, I did 4 contracts. And I brought in 418, so a little more than, $100 per contract. And then if you multiply the 4 contracts by the $5 spread, and then subtract the premium that you brought in, that's where the 1581 came from. Now, this was an 189% return. When you look at the DTEs, it was only 51 days to expiration, and it's this divided by this and then adjusted for the year, and that came to 189% return, which is probably the highest return I've ever had on any of these trades. So, and I may do more. I like, if this doesn't get assigned to me, I'll probably do another one, unless something crazy happens with Path. And by doing those trades, again, I've been able to reach my monthly goal, which is 6,400. So I was a little bit higher, 6,515. So that's what I wanted to show you. Again, this is a little bit different from what I've done in the past. I typically have stuck with safer, less risky stocks, what I call value companies that pay dividends. But this is a whole different look and feel for what I've done in the past, with the exception that both of these companies are making money. Both have a good handle on debt. One is more profitable than the other. So in that sense, I'm not taking a ton of risk. I'm still picking companies that I believe in. And both of them, I've looked at their products and like what they offer. So that being said, as always, leave a comment. If you disagree with how I've done this or disagree with the trade, let me know. And as always, I look forward to seeing you next time. Bye-bye.